Gold just hit $5,278 per ounce on February 28, 2026. And this weekend, investors are not selling a single ounce, not one. What do they know that you do not? Welcome to the Capital Anchor. I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now because what I am about to show you will change how you see gold forever. Let me give you the exact timeline first. On January 29, 2026, gold hit an all-time record of $5,595.42 per ounce. That was the peak everybody celebrated. Then it crashed hard. Within days, gold collapsed to $4,401.72, a drop of over $1,193 in less than 2 weeks. Panic spread fast. Media called it a bubble popping. Retail investors scrambled. Financial pundits said the rally was over. The narrative was clear, gold had topped. But here is what happened next. Gold did not die. It clawed back, $4,700, then $5,000. Then $5,181 by February 25, then $5,278 by today, February. Arshabah. That is a recovery of $876 in under 4 weeks. And this weekend, markets are closed. Gold cannot trade, but investors are still refusing to let go. That single fact, people clinging to gold over a weekend when nothing can happen, tells you more than any chart ever could. Understand this. Behavior during silence is the loudest signal in markets. Now let me explain the hidden mechanism most retail investors completely misthink about a water tower in a drought. The tower holds all the water. Nobody uses it. Nobody sells it. The moment that changes, every drop becomes priceless. Gold markets right now work exactly like that tower. Central banks have been buying and never releasing. Their gold is locked. It never returns to the open market. The available float is shrinking quietly, week by week. Central bank purchases averaged 1,045 tons per year over the past 3 years. That is 221% above the levels seen between 2010 and 2021. This is not a cycle. This is a structural break. In 2025 alone, central banks globally bought 863 tons, that is gold permanently removed, from the tradable pool. In 2026, they are expected to buy another 850 tons minimum. China's official reserves have already surged to 2,306 tons. Beijing is systematically swapping U.S. Treasury holdings for physical gold bars stored in domestic vaults. This is not investment, this is architecture. Poland's national bank added 102 tons in 2025 alone and just announced plans to buy another 150 tons in 2026. Their target is 30% of all reserves held in gold. That is a sovereign nation rewriting its balance sheet. Now let me give you the reasons this happened. Reason number 1. The United States formalized a 15% flat tariff on all imported raw materials and finished goods on February 23, 2026. That single policy announcement shook every emerging market. When tariffs hit, trade war fears return. When trade war fears return, the dollar's dominance as a settlement currency gets questioned. When the dollar gets questioned, gold becomes the answer. That chain reaction happened in real time this week. Reason number 2. The Federal Reserve is stuck. US debt is at historic levels. Real interest rates, the rate minus actual inflation, remain negative or near zero. Holding cash costs you money and purchasing power every single month. Gold does not yield anything, but when your alternative yields less than inflation, gold's zero return suddenly beats every safe bond in the market. That math is what pushed investors to hold this weekend, not sell. Reason number 3. Goldman Sachs, Bank of America, MKS PAMP, and ANZ all released major gold price targets this month. Goldman sees $5,400 by year-end. Bank of America projects $6,000 by spring 2026. ANZ targets $5,800 in Q2. MKS PAMP said this gold bull market is mid-cycle and projects $6,750 by the 2026 US midterm elections. When 4 major institutions publicly agree on this scale, institutional money follows. Smart money does not ignore that consensus. Now here is the disconnect most people watching this video have completely missed. While retail investors saw gold crash from $5,595 to $4,401 and panicked, central banks described that drop as a strategic acquisition opportunity. J.P. Morgan's analysis explicitly labeled central banks as structural dip buyers. That means while you were reading headlines about gold crashing, they were placing buy orders. While you were frozen, they were accumulating. That is the disconnect. While retail investors were told the rally was over in early February, the People's Bank of China was still purchasing its 15th consecutive month of gold. Turkey was buying. India was buying. Poland was accelerating. The buying never stopped. The mainstream narrative told you the correction was a warning sign. The institutions treated the same correction as a discount sale. That gap in understanding is exactly where wealth transfer happens. And it is happening right now. Let me take you back to March 2022. Gold hit $2,070 per ounce. Then it crashed 20% in 2 months. Retail investors declared the rally finished. They sold, they moved on, they looked elsewhere. The mainstream media confirmed their decision with negative headlines every single week, but central banks kept buying, quietly, systematically. By March 2024, gold had climbed to $2,300. By September 2024, it crossed $2,600. By January 2026, it touched $5,595. The people who sold in May 2022 missed a 170% gain. The people who held through the fear made life-changing returns. That pattern is repeating right now, today, February 28, 2026. Understand this clearly. The structure of this market has not changed. The correction from $5,595 to $4,401 was violent, but the foundations underneath gold have not moved 1 inch. Structural factor number 1. Central bank buying continues at emergency pace, over 1,000 tons per year for 3 consecutive years. That demand does not slow down during price corrections, it accelerates. Structural factor number 2. The US dollar is losing its grip as the world's reserve currency. BRICS nations now settle over 31% of bilateral trade in non-dollar currencies. That number was 9% in 2019. Structural factor number 3. COMEX registered gold inventories. The gold available for actual physical delivery stand at roughly 17.2 million troy ounces as of February 2026. Open interest contracts represent claims on far more than that. The paper-to-physical ratio is dangerously stretched. Structural factor number 4. Real US interest rates remain effectively zero or negative when measured against true inflation. The Federal Reserve has no political room to raise rates aggressively. That environment is structurally bullish for gold. Now I am going on the record. Screenshot this right now. Gold will reach $6,200 per ounce by June 30, 2026. That is my target. That is my time frame. I am stating it directly, not hedging it. Here is why. The institutional price targets from Goldman, Bank of America, ANZ and MKS PAMP all cluster between $5,800 and $6,750 in the first half of 2026. Central bank buying is removing supply faster than new mining production can replace it. Global gold mine output grew only 0.5% in 2025. Demand grew 18%. That supply gap does not close quickly. It takes years to open a new mine. The imbalance compounds every quarter. Now let me give you the 3 scenarios and their probabilities. Scenario 1. Gold continues climbing steadily, hits $6,200 by June 2026, driven by continued central bank purchases and dollar weakness. Probability, 60%. Scenario 2. A short-term correction to $4,800 occurs in March or April 2026 as profit-taking hits, followed by a recovery and eventual push past $6,000 by August 2026. Probability, 30%. Scenario 3. A major deflationary shock, unexpected Fed rate hike, sudden dollar surge, global credit event forces gold below $4,400 temporarily. The bull thesis pauses but does not break. Probability, 10%. Now let me talk directly to you based on where you are right now. If you are holding physical metal, the data says hold. You own the most liquid, most universally accepted store of value on Earth. Weekend volatility is noise. Your thesis is intact. If you are trading with leverage, understand that a $5,278 gold price with $876 recovery momentum is not a place for aggressive short positions. The risk-reward is asymmetric and not in your favor right now. If you are sitting on cash watching from the sidelines, understand what waiting costs you. Every month with real negative interest rates, your cash loses purchasing power. The data says the entry window is still open. If you bought near the top at $5,500 and are currently underwater, understand you are not in the wrong position. You are in the wrong time frame. The institutions that agree with your thesis have 12 to 24-month horizons, not 12 to 24-day horizons. Now here is what you need to watch going forward. Watch the DXY, the US dollar index. If it breaks below 99, gold accelerates. Every point the dollar loses, gold gains structural tailwind. Watch COMEX registered inventory levels weekly. If physical delivery stock falls below 15 million troy ounces, a supply squeeze becomes a real near-term threat. That event would be violent and fast. Watch the World Gold Council's monthly central bank purchase data. If buying drops below 60 tons per month for 2 consecutive months, reassess. Until then, the structural buyer is still in the market. Watch the US 10-year real yield. If it turns meaningfully positive above 1.5%, that is the one scenario that genuinely challenges the gold thesis. It has not happened yet. Now I want to talk about the 3 types of people watching this video right now. The first type is panicking. They saw the crash from $5,595 to $4,401 and cannot sleep. They are checking prices every 20 minutes this weekend even though markets are closed. The second type is frozen. They understand gold is strong but cannot decide whether to act. They have been watching for 6 months and have not moved. Fear of being wrong is louder than the data. The third type is learning and preparing. They are watching this video, taking notes, checking the indicators I just gave them, and building a framework. They are not reacting. They are positioning. The market does not move wealth randomly. It moves wealth from the impatient to the patient. It moves wealth from the people reacting to headlines to the people reading structural data. That is not philosophy. That is how markets have functioned for 5,000 years. Gold investors clinging to their positions this weekend are not being stubborn. They are being informed. They understand something the panic sellers do not. The question from the opening of this video now has its answer. If this helped you see gold differently, hit the like button right now. Subscribe if you are not already here. I release market breakdowns like this every week. Share this video with someone who is stressed about their portfolio this weekend and drop this exact phrase in the comments. I am the third type. Let me see how many of you are building, not panicking. This video is for informational purposes only and does not constitute financial advice.